Mr. A.K. Jain, Executive Director of Ipca, joins us now to talk about the new FDA approval for their indoor facility. Mr. Jain, good morning. Thank you for joining us. US FDA has finally approved your indoor facility. What is the importance of this approval? And because of this FDA approval, how will your numbers change in the short term?
In short term, the numbers would not change. It will take around 4 months' time to line up the supply chain. Maybe in the next financial year, we should be able to add almost around 100 crore turnover from this particular facility.
So, which of the products will be exported from this particular SEZ?
We have almost around 36 filings right now, and by year end we will have more than 40 filings, 42 filings overall. We have currently around 15 approvals, and we only commercialize around 8 products. So there are around 7 products which need to be commercialized. So that is what we are planning. Plus in existing products, whatever we have commercialized, there also we are facing the capacity constraint. So we should be able to even increase the volumes of the existing product itself. So that's our game plan.
So how many products will you shift from Silvassa to Indore?
As far as Silvassa shifting is concerned, 2 products we have already shifted, and I think 2 more products we will be shifting. So almost around 4 products we will be shifting from the area.
Will this Indore facility add to your top line, or there will be no material impact to your top line? You will only benefit because of cost savings and because of synergies.
No, this will certainly add to the top line of the companies, and also currently this facilities we are incurring almost around 35 to 40 crore annual expenditure, which is being debited to the P&L account. Mere recovery will push our profitability, and this business is one of the high EBITDA margin business for us. So definitely this will add to the margins of the company also.
Mr. Jain, if I look at your earnings trajectory, for 3 or 4 quarters in a row now, your margins have expanded. Why is that happening? Is that because of better efficiency or the fact that you managed to move up the value chain?
We are currently around say 22% kind of EBITDA margins, and the margins are quite stable at these levels. And going down the line, if the dollar rupee remains at this particular level, and since business mix is also changing towards the better margin, so we feel that there will be some expansion of margins going down the line.
Mr. Jain, what's the next step then for the company? Because analysts do believe that the next step going forward is going to be to develop value-added products for the US markets. What's the company's strategy in this regard going forward?
Our current strategy is to see that whatever we have on our API basket is to forward integrate that into the formulation basket. So that is what currently we are doing. We have almost around 80 products under development, and now under R&D there are various products which are difficult to make. Some kind of sustained release, control release, and those kind of preparations. So on which the R&D is currently working, and filing has also started on that line. We are also looking into the various other therapy areas to enter, like your hormones is one particular area for which we have just commercialized an API facility, and now we will be filing DMF, and henceforth we will be also filing your formulations after putting the R&D for that. So that's the journey we are taking up. So definitely this journey will result into the higher margin businesses for us.
What is happening to your core business? Your core business is antifungal and anti-malarial drug.
Let's say in India, our we have leadership in anti-malarials, we have leadership in rheumatoid arthritis, and almost around more than 30% of our business in India comes from pain management segment. The second big segment for us is cardiovascular and anti-diabetics, which contribute almost around 26% of our business. Malaria just contribute around 16% of the business. So as far as malaria, the pain management is concerned, we are continuously beating the market and growing much higher than the market growth. As far as cardiovasculars are concerned, we are little better than the market, but not beating handsomely in that particular case. And as far as malaria is concerned, we are driving the market. But this year malaria growth is little slow, because in the month of your August and September, malaria is a little weak. So we don't expect great numbers to come out of the malaria business in current financial year for domestic markets are concerned.
Final question, your Q1 numbers were strong. Are your Q1 numbers an indicator of what you could report for the rest of the year, or was Q1 more like an aberration? Because what you reported for Q1 was a solid set of numbers. Profits were up by about 66%.
If you look at the Q1 numbers, I think we had some better institutional sales overall. As far as the domestic business was concerned, that was as usual, and we had a good growth in domestic in first quarter. The branded generic business, which is there in emerging market, that business is continuously doing well and will continue to do well. Overall, for the whole of the financial year, we have given guidelines that we should be around 18 to 20% kind of growth, and hopefully we should be in a position to achieve that kind of growth. And that number growth we have given at the overall your currency level, which was around 57, 58 level. Now since currency is at 63, 64 level, there will be some improvements, but it all depends at what level the currency gets stabilized.